Portfolio allocation is one of the most challenging areas of investing. Which investments deserve more capital than others? How to know? Today, I'll be showing you some of my portfolio allocation options. I'm Skylar James. Welcome back to the channel. This is my third video in my series using ETFs to retire in 10 years. Each of them are standalone, so don't worry if you haven't seen the other two. But in parts 1 and 2, I laid out 10 sectors and various ETFs within them that are ready to beat the market for the next 10 years. You'll want to watch those videos as well if you want to see the full picture of my investment thesis. Remember, this isn't investment advice, it's just how I do things to keep my portfolio humming along. I hope you find these model portfolios fun and interesting. The like button is a great way to tell me that you like this kind of content. I created 4 model portfolios for this video. Some are more aggressive than others. Be sure to check out my dedicated video on how to use my new ETF rating system if you're interested in a fun way to evaluate ETFs. I'll be using terms from my fresh video in this video. Let's jump into the portfolio. As a reminder, these are the 13 ETFs across 10 categories that I chose for my retire in 10 years list. First up, let's do an equal weighted approach, setting all 10 categories at 10% each, and the categories with 2 ETFs I'll split evenly. What kind of exposure does that give me? Actually, pretty aggressive exposure, about the opposite of traditional equal weighted allocations. Here's why. Equal weighted ETFs typically stop the biggest or strongest stocks from steering the performance, but equal weighting ETFs is a whole different ballgame. Take, for instance, the cannabis ETF, CNBS. It has 34 holdings at a 10% allocation. That means 0.7% of my entire portfolio would be allocated to Tilray and 0.5% to Canopy Growth. We could run through each of these concentrated ETFs and poke the same holes in them. On top of that, the real-time visibility is low, meaning it's hard to know what each of these ETFs is holding and at what percentage without a bunch of legwork. Getting familiar with the portfolio would be an uphill battle. The path of least resistance is to just pass on equal weighting this scheme altogether. It isn't the right approach for me. On the other hand, let me show you what a tame allocation of these ETFs would look like. This is a portfolio where I can rest my head easily each night, tonight and every night, never checking my balance, trusting that I'll come out ahead on the other end. You can see here I chose to allocate outsized capital to the broad VUG Vanguard Growth ETF. That ETF has given me market-beating performance, but in a much broader area than just new and advancing technologies. I get that Home Depot, that Costco, that Moderna exposure. 3 examples of why VUG is a great complement to tech portfolios. After VUG, I'll lean on large cap semis and software, and then the mid caps. Remember that semis and software are inflation hustles, great assets to hold as a hedge during these inflationary times. KRBN is high on my conviction list, so I can keep it at 10%. Remember, it's a non-traditional asset with a great runway. The most futuristic areas of tech get just 3% each. That's data, AI, and cybersecurity, all round out with modest allocations to cloud and clean energy. And you can see cannabis barely makes a blip on this portfolio. This is probably the least volatile and safest portfolio allocation I could create using these ETFs. How about the opposite? What's the most aggressive portfolio I could assemble with these ETFs? What do I mean by aggressive? Guess I mean volatile, but with the biggest upside potential. In fact, with most investments, volatility equals the most potential upside. So here we go. Now remember, there's a difference between a calculated risk, a chance, and gambling. This is a calculated risk portfolio. This isn't a YOLO. This isn't a dice game. This is an aggressive calculation. Run through it with me. Semis are the new oil. Carbon allowances are poised for a decade of dramatic returns. AI is the future. Cloud is only in the first inning. Software runs everything. Cybersecurity goes up with every single hack. Data is the new oil. And round it out with growth, cannabis, and clean energy. Like I said, this is an aggressive calculation, far from a sure thing, but sure could beat the market by 1.5 miles. That's 3 portfolios so far. We looked at equal weighted, tame and aggressive. Is there a better way to do this? Shouldn't the best portfolio be one where I allocate money toward the stocks I'm most confident in instead of just this super specific lens of futuristic technology and changing legislation? After all, the performance of these ETFs is literally stock-based, is it not? So I ranked all 10 categories by my expected performance, 1 to 10. Which ETFs will perform best over 10 years? 1 being the best performer, 10 being the worst. And hey, if anybody is still listening to me in 10 years, we can all come back to this video and compare my predictions to the results. But here are my projected performance ratings of these ETFs. Let's talk about the bottom first and work our way up. Cannabis, IRBO, and clean energy. They're not bad, they're just in the hangar, to use vocab from my fresh ETF rating system. These are investing ideas that are still in the hangar and not on the runway. And they could be in the hangar for another year, 3 years, 5 years. I don't know. When we're talking about 10 years of performance like we are here, that unknown hangar status keeps these 3 at a disadvantage. Going up the rankings from there, VUG is too broad to beat pure tech plays. It sits in 6th place. Cybersecurity is a victim of simply currently high multiples and high valuation. Comes with the territory in this sector. Semis are a great investment and we need them in everything. The demand for semis grows at twice the growth of GDP. That said, it's CapEx heavy and I don't expect this semi shortage to end next year or even 3 years from now. The continuing shortage means semi manufacturers will keep spending more money on fabs to keep up with the demand, which pinches margins in the near term. But semis are an inflation hustle. They can pass costs on to their customers. So this outsized profits over the long term. I peg semis at 5 for this list. The KRBN thesis is strong. The price of carbon will continue to rise in the existing trading systems, and new ETSs will come online this decade, and the prices will rise as well. KRBN is a wild card to be the best performer on this entire list, but I'm not disrespecting it by ranking it all the way down at number 4. Most investors probably wouldn't put it in their top 100, so 4 is plenty of respect. Check out my KRBN playlist if you need to get caught up. So the top 3 categories for stock performance as I see it are software broadly, hypergrowth, cloud, and data refiners. Data refiners being the best performer. Facebook is your grandfather's version of data. The new data kings are only known to techies and coders. The same is true with cloud architecture. These companies have phenomenal margins and are seeing exponential increases in demand. They are a no-brainer win as businesses, but as stocks, they're often cursed with high multiples and susceptible to big run-ups and then slow, painful drawdowns. Remember though, volatility often leads to outperformance. So let's step back. You can see that my 10-year thesis is heavy on software, semis, and carbon allowances. An easy thesis to agree with, wouldn't you say? Software as a whole is very mature. Think of names like Microsoft, Adobe, and Salesforce, with still new energized companies rising up the ranks. I think a safe bet is that high margin software outperforms going forward. But cloud and data are where I'm betting the biggest money is to be made for investors like you and me. So here's my allocation in response to these rankings. This portfolio takes into account all we talked about today, from the pros and cons of equal weighted allocations, to the importance of keeping it tame and being able to sleep at night, to being aggressive by both industry and stock outlook. This is the portfolio I ended up with. What do you think? I would love your feedback in the comments section below. If this is your kind of video, let me know by hitting the like button and subscribing. Thanks for watching, and I'll see you on the next one.